Hey everybody, welcome to your week in review for the week of July 11th, 2022. And oh, what a week it was. For bonds, the week started off right on Monday. Not so much for stocks. Stocks were down early based on new reports coming out that Shanghai is having its first case of the highly infectious BA.5 Omicron subvariant, opening up the idea of more slowdowns coming on supply chain issues out of China. That helped bonds. MBS started off the week being up 31 basis points early. The 10-year Treasury was down 11 basis points on the open today. And they pretty much stayed right around that same mark the whole day through. We also got a report out of Redfin on housing data. 52% of the homes sold last month were over list price, which was down from 53% last year, so not a huge change. Median days on market was at 18, which is flat. 32% went under contract in the first week. The average sales price was 1.9% over ask price, which was down from 2.2% last year. And the really kind of crazy one to me was 15% of purchase agreements fell through in June, which was relative to 12.7% in May and 11.2% in June. Which has me wondering, I had heard somebody say recently that a high percentage of cash offers were actually falling out in the market, that a lot of the investment companies were making multiple offers and then using the inspection period to whittle through the ones that they actually wanted to keep. So those cash offers weren't quite as good as a lot of people were thinking. Also got an interesting stat today. Car repos are way up, particularly on cars bought in 2020 and 2021. Apparently during that time, the average LTV was around 140% of value versus the 80% normal LTV on cars. To me, both of those numbers sounded wrong. I would have thought the normal would be higher, and I didn't think cars could go up to 140% LTV. By contrast, the average LTV on homes is about 42%. It's a big week because we got CPI numbers coming in, which is basically inflation readings. The market expects 8.6 to 8.8% year over year, which would equate out to 1.1% month over month. It's likely going to be volatility associated with this release. We also have 10-year and 30-year bond auctions. We're starting out the week with MBSs flirting with, battling, testing that 25-day moving average. We have a convergence of technical lines kind of working with each other today. We did manage to close above the 25-day moving average, but below that Fibonacci level at 100.603, which has been a floor and a ceiling over the last month or so. And then the 50-day moving average is also coming down into the picture. So if we fall and stay below that 25-day moving average, you can see there's quite a bit of room to the downside. Though if we can fight through all three of these levels, there is some room for improvement. In other news, the market is gauging the possibility of a recession. We're coming into earnings season. This is going to especially factor in on companies with big overseas operations. Microsoft has already warned that the US dollar will take a bite out of their profits. Also, we have chip shortages that we're still dealing with. The profit outlook for banks is going to be dented by lower income from mortgage banking. Wells has already indicated that its Q2 mortgage banking profits are going to be down about 50% versus Q1. Over the weekend, we got news that Elon Musk has terminated his $44 billion offer to purchase Twitter. My initial thoughts pretty much echoed right what Elon said with a well-timed meme today, where he said, first they said I couldn't buy Twitter, then they wouldn't disclose bot information. Now they're going to take him to court over it. Now they have to disclose the bot information in court. So this whole thing could be a very elaborate play to call Twitter out over this issue. We'll have to see how this one plays out over time. And then there was Tuesday. Tuesday was a great reminder of how wild and woolly our financial world is right now. Bonds opened slightly stronger as Asian equities declined in both Japan and China, led to a positive open for bonds being up 17 basis points early, and stocks were down 15 points pretty early, based off of the economic outlook out of Asia and China's struggle with COVID. The dollar is also hovering around levels last seen at the height of the 2020 market panic over COVID. The greenback is actually right around being dollar for dollar with the euro, which has been quite a while since that has happened. All eyes are on the CPI data coming in tomorrow. That's going to be the big deal and going to move a lot of volatility, as evidenced by today. The bond yield curve continues to invert. The 2 to 10 spread, meaning the 2-year rate compared to the 10-year rate, is now minus 0.10. So the 2-year is actually 10 basis points higher than the 10-year, and the 10-year is even below the 1-year. So pretty weird on that. Pretty reliable recession indicator with that inverted yield curve, and these aren't just for blips. It's staying there right now. MBS were well above the 25-day moving average this morning before everything fell off. It was actually making a run at that 100.603 technical line. That's been our line of ceiling and floor for a couple of months now. Then we got the bond auction. We had a 10-year auction today, and bonds lost 15 basis points. Our MBS lost 15 basis points almost immediately after that and kept on sliding. We ended up being down 25 basis points on the day, which was 39 basis points down from the very, very opening part of it and 45 basis points lower than the best part on the day. So bonds gave up that ground, ending up at the 4.5 being at 100.02. So it's below that 25-day moving average on the chart, and we're going to have to see what the CPI numbers come in tomorrow to see if it's going to make a run at that line at 99.281. Sure hope not. With more bad news, we got Loan Depot doing a massive restructuring. Looks like they plan on decrease their workforce by 43%, which is an awful lot. Their outlook is quite dire. We anticipate continued challenging market conditions, with mortgage originations projected to decline by roughly half in 2022 from 2021, including an accelerated decline in the second half of 22 and a further decline in 2023. Their stock has been a disaster, down 70% year to date. Current dividend of 8 cents per share. Ain't gonna happen. We also got a post today from WellThatMakesSense.com. Go over there and check that out. It's the start of a new series from the book Becoming Supernatural by Joe Dispenza. The mind thinks, the heart knows. When you can maintain your internal states independent of your external conditions, you are mastering your environment. So this is kind of all about being able to master your internal states, even if the bond market is doing this kind of stuff. And then tomorrow we're going to get the coupon rollover, so expect some wonky charts in the morning, but we got CPI numbers, and that's all that really matters. After a wild and crazy Tuesday, Wednesday said, hey, hold my beer, watch this. In the morning, the CPI number came in much hotter than expected, and nobody liked it. Not you, not me, not stocks, not bonds. Stocks were off 36 points early, and MBSs were down 53 basis points bright and early this morning, right out the gate. CPI set inflation at 1.3% for June, which was higher than the 1.1% expected. Year over year went from 8.6 to 9.1%, which is a lot. The core rate, which strips out food and energy, rose by 0.7%, where 0.6 was expected. Year over year went from 6 to 5.9%. Rents are up 0.8% for the month. Energy was up 7.5% last month alone, which is 42% year over year. Gas was up 11.2% last month, which is 60% year over year, which is kind of feeding into my tinfoil hat conspiracy idea that the administration actually doesn't care about gas prices. They're going to use that as an extra tool to curb inflation, because if you're spending all of your money on gas, you can't go out and buy all the other stuff too. And they think that, we'll blame it on Putin. No big deal. What we have is all systems go for another Fed increase of 0.75 of a point at the next meeting, maybe even 1 full point. Fed futures shows a 50% chance of a 1 point increase at the next Fed meeting. The shoe has even yet to drop, so these numbers are actually worse. Rising home prices affect the CPI on a 12 to 18-month lag, so the torrid home price appreciation of the last 2 years is only beginning to creep into the numbers, and we know that the impact of rents in here isn't even up to date on what it is in most places. I found this interesting. I saw this today. Since the Bureau of Labor Statistics consider housing an investment good rather than a consumption item, it measures home price changes within the CPI is something called owner equivalent rent, where essentially they will call people and say, what do you think you could rent your home out for? Not very scientific and very much lagging. The yield curve is further flattening. The 2 to 10 spread is now at 17 basis points. So the 10-year rate is actually 17 basis points below the 2-year, which is not how it's supposed to be. In a pretty decent 30-year bond auction today, the bid to cover was 2.4, which was higher than the average of 2.34 over the last year, which helped the market, but it doesn't explain the total rebound we had. We ended up being up 5 basis points on a day after being down 53 basis points, which was a pretty big turnaround. No real obvious culprit for it. However, there's a bunch of other smaller pieces. We had a strong bond option. There was some short covering. There's a couple of other things to just kind of go into it that made it come back around. But all in all, it was a long road to flat on the day. At one point, we even made a run at that 99.281 technical level before closing back up over that 25-day moving average. That 25-day moving average and the 100.603 number is showing to be a very strong technical indicator. The other thing that's going on that maybe you're not paying attention to is what's going on in currencies between stocks and bonds, crypto, other stuff. It's hard to keep up on what currencies are doing, but for the first time in 20 years, the euro and the dollar are pretty much trading 1-for-1, and this is based off of the Eurozone reaching record inflation of 8.6. Bunch of copycats over there, I tell you. So we'll have to see how the market reaction is tomorrow to all this data as well. Brought to you by a volatile Tuesday and Wednesday. Thursday brought us volatility. In a world where we are alternating between worry about inflation and worry about recession, Thursday was definitely a worry about inflation day. MBS were down 45 basis points early, going down as much as 51 before rallying back to close the day, being down 19 basis points on the day. Stocks were down 67 points real early, though it came back around to only be down 11.4 at the end of the day. Most of this is driven by a higher than expected PPI index. The producer price index, which is inflation on the production of goods, rose 1.1% last month, which is 11.3% on a year-over-year basis. It's pretty hard for the price of goods, CPI, to drop when the cost to produce goods is going up that fast. Final demand when you strip out food and energy rose by 0.4% month over month, which is 8.2% year over year, which is also very high. You guessed it. JP Morgan reported earnings and missed Wall Street expectations. Earnings per share fell by 27% year over year. Mortgage banking revenue was down 14% quarter over quarter and 27% year over year on lower production, saved somewhat by higher servicing income. Why is everything got to be our fault? But the increase in CPI and PPI has changed the outlook for the July Fed meeting. The markets are now predicting an 83% chance of a 100 basis point hike in July, with another 125 basis points coming between then and the end of the year. The fact that we're talking about recessionary conditions now, with this much tightening ahead of us, does not bode well, because typically this stuff runs on a 9 to 12 month lag. So it does not bode well for the economy in 2023. The spread between the 2-year and the 10-year, which we've been talking about quite a bit, has gone even more negative, falling to 23 basis points. This recessionary indicator is flashing bright red. We also got jobs numbers. Initial jobless claims came in up 9,000 to 244,000. The number isn't terrible, but the trend is moving higher, so maybe the jobs market is starting to soften. As you saw from the graphs, and you saw it today, started out very, very negative, being as much as 51 basis points down at one point. Made a run at that technical line at 99.281 before rebounding back to consolidate on that 25-day moving average. The 25-day moving average, as you can see on the graph, and we've talked about many times, is really holding strong as an alternating floor and ceiling with that 100.603 at it's been snaking around it like a double helix all for the last couple of months. So we'll have to see what happens on Thursday. Hope you. And why would we expect a volatile week to end with anything other than a volatile Friday. MBS actually opened this morning down 6 basis points, rallied to 13 basis points positive about the time I got up and got moving around, and ended the day up 38, so a pretty big rally in the afternoon. We got retail sales, which rose 1% last month, which is better than the expectations of between 0.7 and 0.8. Core retail sales were up 0.8%, which was better than the 0.3 expected. Also, the New York Manufacturing Index was 11.1 when it was expected to be -2, though the outlook dropped pretty monumentally. Stocks were up 49 points early, ending the day up 72 points. Kind of interesting that market sentiment is so low, inflation is high, housing is going up like crazy, but jobs are doing well and people are still buying things. So there's a lot of things to interpret and bet on regarding inflation, but more and more people are betting on a 1-point Fed increase this coming month. Yesterday, the MBS made a test at that 99.281 line, which is right down here. It failed, so it bounced back up. We are now back above the 25-day moving average at 99.923, and hopefully we'll test and go back above that fat line at 100.603. At this point, I almost feel like I should get a 100.603 tattoo. I'm saying it so much the last couple of weeks. Wells Fargo also reported earnings this morning. Earnings per share declined 47% on a year-over-year basis. Revenues were down 16%. A lot of it had to do with mortgage banking revenue being down. Also, with inflation, with inflation being high, we are starting to see a lot of shrinkflation. This is where the price stays the same, but the amount you get changes. A recent article from the New York Post shows difficulty in measuring inflation. BMW is now requiring subscriptions to use heated seats and automatically adjusted high beams. Also, CarPlay requires an upfront fee. So this is an example of shrinkflation, where they're keeping the price of the cars the same, but to use all of the stuff that goes up. So they're only going to measure the change in cost of the car. We haven't seen inflation like this since the late 70s. Chris Maloney over at Bank of Oklahoma had a great history on how that got fixed when it was this high. The big reminder from it was it took like 3.5 years to fix, not 6 months. So buckle up, Buttercup. There's also some things in the zeitgeist of mortgage, some industry ugliness. It looks like there is apparently a big online feud going on between Anthony Casa, the former head of the Association of Independent Mortgage Executives, which people have feelings about, and the CEO of Fairway Independent Mortgage Company, which people have feelings about. All in all, seems pretty ugly to me and pretty unnecessary, but it's going on out there, so we'll have to see if that bubbles up, gets higher, or people get back to normal. I guess there's also some story about a probably fake email from Jacobson threatening terminations over memes, although from what I've heard on that, I haven't seen the memo myself. Somebody said that you'd basically have to accept that the guy that runs one of the largest lenders in the nation is borderline illiterate, so probably nothing there. Is a good example of why it is important to mind your own brain, which brings us to a post we got today from our sponsor at WellThatMakesSense.com. So this is all about tuning into the frequencies and the energies around you that are going through you in order to manage your mind better in these tumultuous times. So definitely check that out at WellThatMakesSense.com. Looking at next week, not a ton of market moving data. There's a lot of data. Housing's information coming in, but the main ones that can probably move the bond market are on Wednesday when we get crude oil inventory. Anything having to do with oil and gas prices right now is a hot topic. You get the European Central Bank statement on Thursday. We get the Philly Fed Business Index as well as jobs on Thursday, as well as a 10-year note auction. And then we get some PMI inflation numbers on Friday. Not big on buzzwords and not crazy about the necklace, but I like the idea here. It says, because I survived, because the fire inside me burns brighter than the fire around me. With all the stuff going on in the industry, the bond market, housing, recessions, hopefully everybody's keeping that in mind and keeping the fire brewing within inside them to come ahead, because people are saying there's a recession coming, but I'm going to choose not to participate. Have a great weekend.